Tether invests $200 million in neural implant startup. Tether, the issuer of the largest stablecoin USDT, has invested $200 million in the neural implant startup BlackRock Neurotech, according to Bloomberg. The investment was made through Tether's recently established venture capital division, Tether Evo. The funds from Tether will be used to scale technologies for rehabilitating patients, which have already been tested on 40 subjects, and for future developments and technologies. BlackRock Neurotech specializes in producing brain-computer chips and other devices that could significantly expand human capabilities. Bitcoin endures worst month since FTX collapse. The cryptocurrency experienced a 14% depreciation in April, marking the most significant monthly downturn since November 2022 when Bitcoin lost 16% of its value. The previous March saw a surge in excitement around American Bitcoin-based ETFs, which propelled the price to near record highs of almost $74,000. However, fading hopes for interest rate cuts by the U.S. Federal Reserve have diminished demand for risky investments, consequently depleting inflows into these funds. As of April 29, the 11 American spot ETFs witnessed a net outflow of $182 million. In contrast, these funds had received a net inflow of $4.6 billion in March, following their approval by the U.S. Securities and Exchange Commission, SEC, in January. The much-anticipated Bitcoin halving on April 19, an event that occurs every 4 years and historically serves as a catalyst for price increases by reducing the supply of new coins on the market, had minimal impact on prices. While the halving did not affect the number of transactions that could be processed in a block, it halved the amount of new Bitcoins received by miners. Shares of cryptocurrency mining companies fell more sharply than the price of Bitcoin itself. Marathon Digital Holdings Incorporated dropped by 7.5%, Riot Platforms Incorporated by 5.6%, CleanSpark Incorporated by 7.7%, and Cipher Mining Incorporated by 6.27%. Additionally, shares of MicroStrategy Incorporated plummeted by 15%. On Monday, the software maker, which has made Bitcoin acquisition part of its corporate strategy, reported a first-quarter loss of $53 million. The company had to adjust the value of its Bitcoin assets, despite the cryptocurrency's sharp rise during the period. Market participants were anticipating a new growth impulse from Asia and were closely monitoring the listing of spot ETFs on Bitcoin and Ethereum in Hong Kong. However, the debut on Tuesday failed to restore investor confidence. According to Bloomberg, the trading volume of the 6 new ETFs on the first day was just $11 million, far from the total $4.6 billion trading volume recorded by 10 American spot Bitcoin products on their debut. The market had built up unreasonable expectations ahead of the launch of the Hong Kong ETFs, said Vettel Lund, an analyst at K33 Research. In response to the weak demand from Hong Kong, the decline in Bitcoin and Ethereum prices accelerated, with the two largest coins dropping by 3.8% and 6.6% respectively on Tuesday. Ethereum, the second largest cryptocurrency, depreciated by about 17% in April, marking its largest monthly drop since June 2022. In March, the SEC requested information from various companies as part of an investigation into Ethereum. Last week, cryptocurrency software developer ConsenSys filed a lawsuit challenging the SEC's right to regulate the Ethereum blockchain and Ether. This is the latest in a series of legal battles between the cryptocurrency industry and the regulatory body. Lund added that the drop in demand indicates further volatility. Hong Kong ETFs could never alter this trend, as the best estimates of fund inflows range from 15,000 to 30,000 bitcoins over the next year, which is equivalent to a 2-day inflow into BlackRock's exchange-traded Bitcoin fund in February, he added. EigenLayer to launch Eigen token and conduct stake drop. The restaking protocol EigenLayer is set to launch its native coin, Eigen, in May, with 15% of the total issuance to be distributed among those who have staked assets on the platform. The Eigen Foundation, an independent non-profit organization, will issue the token, as announced. At launch, the total circulating supply of Eigen will be 1.67 billion. The foundation has allocated 45% of the tokens to the community, including 15% for a stake drop, 15% for public initiatives, and 15% for ecosystem development. Project investors will receive 29.5% of Eigen, while 25.5% will go to early participants. Recipients of the asset will be subject to a 3-year vesting period with a monthly release of 4% of the coins. EigenLayer has also released a technical document detailing the token structure and its integration into the ecosystem. The community distribution, which the developers refer to as a stake drop, will occur over several seasons. In the first season, the Foundation will distribute 5% of Eigen based on an activity snapshot taken on March 15. The claim process will begin on May 10, with the second phase starting a month later. Rewards will be calculated on a linear basis, depending on the amount of ETH staked and the duration of the stake. According to the Dune dashboard, the largest independent staker in EigenLayer is identified as an address belonging to Tron founder Justin Sun's team, which is set to receive over 2 billion Eigen. Alongside the token, the developers announced an intersubjective forking security system. This mechanism is designed to eliminate malicious behaviors that are not immediately detectable in the network, such as data hiding in oracles built on EigenLayer. On April 9, the project team launched the main res-taking platform and the beta version of the EigenDA data availability layer on the Ethereum mainnet. Despite the high popularity of the service, a DEX developer known as Chudnov from 3Chain warned of a potential yield crisis in EigenLayer. What are liquid res-taking tokens, LRT, used for? Liquid res-taking token, LRT, is a token designed to generate additional returns by restaking coins on a proof-of-stake algorithm. LRT protocols leverage the security and yield from staking the underlying asset, plus the potential for additional returns through DeFi or actively validated services, AVS, which include cross-chain bridges, oracles, and sidechains. The concept of LRT applications is similar to joint POW mining, like mining Dogecoin or Litecoin, where the same hardware is used to secure two networks simultaneously. One of the main ways to generate returns for ETH without reducing the liquidity of the underlying asset is by running your own validator, which is a complex and costly process. The next step in enhancing staking profits was the introduction of liquid staking tokens, LST, like ACTH from Lido Finance. However, these are still limited by validator yields. For instance, the yield on the ACTH token as of the end of April 2024 was 3.2%. Further uses for LST are currently only available in the DeFi application market. In contrast, LRT allows for further increased yields on the base asset while maintaining its liquidity. For example, the EigenLayer protocol offers profit opportunities by selecting AVS for restaking LST. A user can restake synthetic ACTH, receiving a res-taking token that is exchangeable for ETH on a 1:1 basis. As of April 2024, EigenLayer already has 9 active AVS offerings, with over 10 more being tested on WholeSky. This approach enhances the security of the Ethereum blockchain by using staked ETH in second-layer systems. For instance, an AVS solution from AltLayer enables the use of LRT for validating transactions on second-layer networks like Optimism and Arbitrum. The market for potential additional revenue mechanisms is still forming. Commission payments can be made in the native network asset, as with LST, in the form of retrodrops for provided liquidity, or in other tokens. The increased yield potential of liquid res-taking tokens not only offers opportunities for additional earnings in new investment strategies but also carries risks associated with the development of such multi-tier systems. The complexity of such smart contracts and untested mechanics in extreme market conditions may lead to unforeseen or unaccounted issues. Here are the main possible risks. Liquidity. Synthetic assets like LRT carry a liquidity risk during times of market stress. For example, the Renzo protocol's token lost its peg to Ethereum after tokenomics were disclosed, causing its rate on Uniswap to drop nearly 80% relative to ETH. Multiple points of failure. The multi-tier ecosystem creates a risk of a cascade of problems due to issues at even one level or a single intermediary service. Development and management. The overall complexity of the architecture multiplies all risks inherent to traditional DeFi applications, coding errors, hacks, and inefficient protocol management. As of the end of April 2024, according to DeFi Llama, the risk-taking sector has a TVL of over $16 billion, with EigenLayer leading at approximately $15.7 billion. This was achieved in just 5 months from December 2023, when the sector's TVL was just $250 million. Part of this rapid growth is due to the anticipation of an airdrop from the EigenLayer protocol, analysts from Glassnode stated. LRT protocols were also highlighted by CoinGecko as a key driver in ETH in the first quarter of 2024. Analysts identified a list of major protocols including Ether.fi, Renzo, Puffer, Kelp, Swell, Mantle. It's also worth noting the interest in the LRT market from companies like Google. In April 2024, the cloud divisions of Coinbase and Google Cloud joined EigenLayer as operators. Experts also believe that the significant growth of EigenLayer could indicate a potential yield crisis. According to experts, the project is growing at rates too high relative to AVS. As a result, the yield offered by the protocol could drastically decrease, leading to a liquidity outflow. Judge approves $450 million settlement between FTX and Voyager. A judge has approved a petition allowing the debtors of the now-defunct cryptocurrency exchange FTX to finalize a $450 million settlement with the bankrupt firm Voyager Digital. In a statement filed on April 29 in the U.S. Bankruptcy Court for the District of Delaware, Judge John Dorsey ratified the terms of the agreement between FTX and Voyager, which will enable the latter to settle all claims with the cryptocurrency exchange as part of a creditor compensation plan. Upon approval, both parties will agree that $5 million held in escrow by Voyager, along with an additional $445 million involved in a loan repayment lawsuit from Alameda Research, will be transferred to the firm's debtors. FTX will also relinquish all rights to the funds. Paul Hedge, an attorney representing the interests of Voyager Digital and its debtors, signed the deal, as did John J. Ray III, the restructuring officer and CEO of FTX, as of April 4. The settlement with FTX is one of several that Voyager has sought since the firm declared bankruptcy in July 2022 amid a downturn in the cryptocurrency market. In April, it was reported that Voyager received a proportional claim of approximately $20 million from Three Arrows Capital and about $14 million from Directors and Officers Insurance as part of its efforts to reimburse users' expenses. The restructuring plan from May 2023 proposed that Voyager clients could recover 35.7% of their claims in cryptocurrency or fiat. In October 2023, the U.S. Commodity Futures Trading Commission and the Federal Trade Commission filed parallel lawsuits against Voyager's former CEO, Stephen Ehrlich, for fraudulent statements. Omnity implements integration for gasless rune trading. The Omnichain protocol Omnity has launched an integration promising gasless token trading for runes, eliminating transaction fees and preventing congestion on the Bitcoin network. According to a statement from the protocol's developers, the integration is based on Internet Computer (ICP) protocol technology, which enables read/write operations on the Bitcoin network and other blockchains. This significantly differs from other Bitcoin interoperability protocols, stated Louis Liu, founder of Omnity and the Octopus network, adding that support for Bitcoin ordinals and Ethereum non-fungible tokens (NFTs) is expected in the coming months. Omnity does not rely on wrapped tokens with assumptions of trust or off-chain relays that can be used. For instance, Wormhole relies on wrapped tokens and off-chain relays, whereas Layer 0 requires two off-network entities, an oracle and a relayer, Liu explained. The integration targets the demand for scalable solutions on the Bitcoin blockchain. The network has seen a surge in activity triggered by the debut of Bitcoin, BTC, exchange-traded funds, ETFs, and new technologies such as Bitcoin Runes, a new protocol for issuing interchangeable tokens on the Bitcoin network. On April 20, the Bitcoin network recorded a new all-time high of 926,842 transactions, with Runes tokens accounting for 68% of blockchain traffic. According to Dune, 3.6 million Runes transactions were processed that day. With all this robust Bitcoin development, developers are rushing to find solutions for trading Bitcoin assets without creating bottlenecks in the network, increasing user risks in the form of exorbitant network fees, Liu remarked. Bitcoin is expected to drive innovation in the crypto space in 2024. Trends associated with the first blockchain include Layer 2, rollups, and seamless integration with decentralized finance, DeFi. Much of the world does not have access to US registered products, but will still need and want to borrow against their bitcoins and earn interest with them, previously stated Mauricio Di Bartolomeo, CEO of Ledn.